Hey everyone, and welcome back to our series on crypto fundamentals. Today, we're tackling a topic that separates successful investors from the crowd. You might be surprised to learn that most people in crypto lose money not because of a market crash, but because they invest in tokens with terrible tokenomics. In this video, I'm going to show you why tokenomics is far more important than hype, and how understanding it can prevent you from becoming someone else's exit liquidity. So let's get straight to it. When you invest in crypto, your real competition isn't just the market's ups and downs. It's the early investors, the project insiders, and the scheduled token unlocks that can flood the market with new supply. Tokenomics is the rulebook that tells you who is set to win and who is likely to lose in any given crypto project. As a retail investor, knowing this information isn't just helpful, it's absolutely critical for your survival. Many beginners make a classic mistake. They look at a token's price and think, wow, this is only 10 cents. It must be cheap. But let me be clear. Price alone tells you almost nothing about a token's real value. What truly matters is the story behind that price. How many tokens exist right now? How many will be created in the future? And most importantly, who holds them? A token priced at 10 cents with a supply of 10 billion is necessarily cheaper than a token priced at $100 with a very small, fixed supply. Tokenomics helps you distinguish real valuation from a dangerous illusion. A key concept here is market capitalization. Most people know the basic formula. You take the token S price and multiply it by the number of tokens currently in circulation. Simple, right? But here's where a lot of investors get burned. They focus only on the circulating supply today and completely ignore the future supply. This is a massive blind spot. If a project has a small circulating supply right now but has huge token unlocks scheduled for the coming months, that initial price pump you see can be incredibly misleading. Those unlocks represent a wave of potential selling pressure that could crash the price. Good tokenomics analysis allows you to see the entire picture, not just the snapshot of today. This leads us to one of the most important questions you can ask before investing. Who actually owns the tokens? Think about it. If the vast majority of tokens are held by the project founders, venture capital firms, and other early private investors, then retail investors like you and me are usually the last ones to the party. And what happens when the lockup periods for those early investors end? They start selling to realize their profits, creating massive downward pressure on the price. On the other hand, good tokenomics is characterized by a fair and wide distribution. It involves long vesting periods for insiders, which means they can't dump their tokens on the market right after launch. It also creates real incentives for long-term participation from the community. Bad tokenomics, in contrast, looks like this. Ownership is highly concentrated. Unlock schedules are short and aggressive, and the entire structure is designed for short-term profit extraction by a select few. Understanding this distribution is your first line of defense. Now let's talk about inflation. Some tokens are inflationary, meaning new tokens are constantly being created, increasing the total supply over time. Inflation isn't automatically a bad thing, but it must be justified. You need to ask yourself a few critical questions. Why are new tokens being created? Who are they going to? And most importantly, is the demand for the token growing faster than the new supply is being created? If inflation is used to reward network validators for securing the blockchain or to fund ecosystem growth, it can be a healthy mechanism. But if it primarily benefits insiders and dilutes the value for everyone else, it's a silent portfolio killer. Tokenomics helps you measure this hidden risk. In the world of crypto, incentives are everything. They are more powerful than grand ideas or revolutionary technology. People act based on how they are rewarded. If a project's tokenomics encourages holding, staking, and using the token within its ecosystem, the price tends to be more stable and can grow sustainably. But if the tokenomics encourages behavior like yield farming just to immediately dump the rewards, you'll see a price that collapses over time, even if the underlying technology is brilliant. Remember, when you invest, you're not just investing in code. You're investing in a system of human behavior. I want to touch on an uncomfortable but crucial point. Many crypto projects, unfortunately, are designed from the ground up for early investors and insiders to exit profitably, and who provides the liquidity for them to sell into? You guessed it, retail investors who buy in later based on hype. Tokenomics is the tool that exposes this structure. If you see a project with huge token unlocks scheduled shortly after launch, a massive allocation for venture capitalists, and very little real-world utility for the token itself, those are giant red flags. Understanding tokenomics helps you spot these traps and avoid becoming the last person holding the bag. So, instead of asking, how high can this token go, which is a gambler's question, start asking the questions of a smart investor who is likely to be selling this token soon. When are the major token unlocks happening? What will create genuine sustainable demand for this token? And does the system reward long-term holders or punish them? Tokenomics provides you with the framework to find the answers. Getting this right gives you a massive advantage. It helps you filter out the noise and focus on projects with a real chance of long-term success. In the next part of this series, we're going to dive even deeper and break down the different types of crypto tokens. You'll learn about utility tokens, governance tokens, and security-like tokens. More importantly, we'll discuss which ones are actually worth holding as a long-term investor. If you want to not just survive but thrive in the crypto market, you have to shift your mindset from a gambler to an investor. Mastering tokenomics is your first and most important step. Make sure you subscribe and hit that notification bell so you don't miss part 3, where we'll explore the different types of crypto tokens and what they mean for your portfolio. Thanks for watching, and I'll see you in the next video.